Good afternoon. My name is Kelly Wilfert. I work for UW-Madison Division of Extension as the Farm Law Outreach Specialist. And my colleague Joy will be joining us shortly. We were having a few technical difficulties getting started today, so thank you for your patience. If you don't already know, here at Extension, we work in a variety of spaces in the Ag Institute, from crops and soils to ag water quality to our role here in farm management. Both Joy and I are on the farm management team and specialize with farm succession work. As we go through the webinar today, which is being recorded, if you have any questions, again, enter them in that chat or the Q&A. If you need any accommodations, please don't hesitate to reach out to us as well. The recording will take probably about a week to process and get captions on, and then we'll share that with registrants as well. So if you don't catch quite everything today, don't worry, you'll have a chance to see it again. So where are we going today? We've got 3 hours together as we start thinking about farm succession. The first hour that we're going to spend together, we'll talk about estate planning for Wisconsin farm families, and I'll lead that portion of the session. Then we'll take about a 15-minute break until 1:45 so that you can get up and use the restroom, grab a drink of water, do whatever it is you need to do before we dive back in with Joy at 1:45 for another hour of getting started with farm succession. We'll take another quick 15-minute break and we'll finish off our time together with basic farm succession tools. All right, let's dive in. As we start talking about estate planning for Wisconsin farm families, these conversations can happen in a variety of ways. And the way that we're going to talk about estate planning for Wisconsin farm families today is thinking about a framework that you can use to evaluate your risk when you're thinking about farm succession and evaluate plans as they're presented to you. So just a little bit about me before we get started. I grew up in Manitowoc County, where my family still farms about 700 acres. I have a degree in agriculture and applied economics, as well as a law degree. I practiced for about 3.5 years prior to joining Extension, and have been with Extension for about 1.5 years. And I really try to merge that real life farm experience with sort of the theory of law and how we can use the law to our advantage as we're business planning. Because I'm a lawyer, I always have to give the disclaimer that although I am a lawyer, I'm not your lawyer. So today's presentation is for educational purposes only. I'll give you a general sense of the law here in Wisconsin as it relates to farm estate planning, but you should always check with your own attorney as you're putting together a plan for your specific situation. So our goals for this first hour are to begin to identify legal risk in farm succession. And as we come back at the end, we'll try to figure out how to help you name and understand some common legal tools for mitigating some of the risks of Wisconsin farm succession. Before we dive in though, where are we today? Why are we talking about farm succession? We read newspaper articles about it. We hear folks on TV talk about it. And I think just about every farm show or farm conference you go to, you'll probably find a session on farm succession. So where are we at? Farm succession continues to be important because we see that the average age of the farmer across the country is continuing to rise. And our farmland owners are telling us that they're planning on transitioning ownership of their land in the coming years. Now, the data you're seeing on the slide here is from 2015 to 2019, that about 10% of the farmland in Wisconsin was expected to change ownership. The new Ag Census, there was another survey done with that. The newest data should come out at the end of this year, and we'll have a sense again of from 2025 to 2029, how much farmland are we expecting to see change hands? But what we can tell from looking back at that 2015 to 2019 data, of that 10% of land that was changing hands, about 23% of it was a sale between non-relatives, 14% a sale between relatives, and about 63% was planned to change hands through a gift, a trust, or a will. And what that tells us is that estate planning and farm succession remain huge parts of what this land transition is going to look like. So whether you are on a farm and have already identified a successor and are thinking about how to transition, or whether you simply own a farm and are trying to figure out what the next steps are, understanding how and why transfer happens is really key. And I say that in part because it matters on an individual basis, right? You want to see perhaps children or heirs succeed, but also from a business perspective as we think about profitability. So when we transfer farms from generation to generation, or truly transfer any business from generation to generation, one of the things that we see change from an economic perspective is that management level efficiency. Just how well does the farm produce under a certain owner or manager? And if you look at the green wavy line on your screen, what we'll see with that farm is that from generation 1 to 2 to 3, that line is sort of all over the place. Sometimes they're producing very efficiently, and sometimes not so much. Now, in part, that mirrors the stages of a business's life cycle. So we have 4 stages of a life cycle in a business. Establishment, where we're first starting to acquire assets and start running the business. We potentially see an opportunity to make some profit down the road, but these early years might be a little bit lean as we're figuring it out. Then we get into expansion. Hey, we've found our niche in this industry and we've decided to start growing. Maybe we've acquired more land. Maybe we have improved our herd production. Whatever it is, we're starting to see a way to expand. But at some point, we look around the room and say, man, I think it might be time to slow down. Maybe someone is getting older. Maybe you're not seeing a next generation looking to take on that operation, or you're not interested in taking on any more debt at this point. And so we start thinking about consolidation, maybe putting a few less assets into the business and preparing for a potential transfer. Now with this green farm, again, we really see the business go through these stages, starting from the bottom where they're just getting established, rising up that green line, through expansion, and of course, hitting a peak and starting to consolidate before a transfer. Now, some of the change from generation to generation with that transfer and the change in efficiency is not, I want to make clear, not just that all folks in generation 3 are terrible at farm management. But the reality is, from generation to generation, different folks will have different skills. So we might see better management efficiency from one generation than another. Often the goal, if we're in a family farm succession process, is to get a little bit closer to that yellow line, that straight dotted line, where maybe we don't really even notice a change in management because we've prepared that next generation so well to take over. We've prepared our farm succession plans so well to transition that efficiency and profitability remains high. Now, it's not always I would say even likely to stay super close to that straight line, but oftentimes that is our goal, to have an efficient transfer. So how do we get there? Often folks will come to me and ask, well, what tools should I use to have an effective farm transition? Should it be a will, a trust? What is it that's going to do the best job? But I really want to back folks up. When you have a problem with a piece of equipment, whether that's a tractor that's not running, or some other piece of equipment that's not functioning the way that you want it to, we might pull that tractor into the shop, but we don't immediately start fixing. The very first thing we're going to try to do is identify what's wrong. Why isn't it working? And so the same thing is true when we think about farm succession. A great place to start is by understanding sort of the default settings. What happens if I don't have a plan? Well, if you don't have a plan, you're ultimately going to hold those assets until you pass away. And what happens then? State and federal law provide a plan for how those assets will transition. if you have not created a plan on your own. And starting with those default settings and evaluating, how do I feel about those? What is it I'm trying to fix before we start selecting a tool to try to fix it is really a key first step. All right, so what we're going to do in the next 45 minutes are dive into those default settings and help you think about, how do I feel about these? So again, what you want to keep in mind is if you do not have an estate plan, state and federal law are going to provide a plan for you that will facilitate the transfer of those assets, namely intestate distribution, probate, estate tax, and long-term care. So let's start off with intestate distribution. Each state in the country has a section of law for intestacy or intestate succession or intestate distribution. You're probably thinking, Kelly, what is intestacy? Intestacy is a legal word for you have passed away without having a plan. You've died intestate. Now in Wisconsin, that's chapter 852. Don't worry, there won't be a quiz at the end. But what you want to know is that what that chapter of the law does is it decides who will get your assets and in what proportions if you haven't decided that for yourself. So for example, in the state of Wisconsin, you've probably heard that we are a marital property or community property state, which means that if I'm married, my spouse and I each own 1/2 of our property. And what intestate distribution in Wisconsin says is that if I pass away and my spouse survives me, my 1/2, if we only have children from our relationship or don't have any children at all, my 1/2 of the assets are going to pass to my spouse. Now, if I'm not married, but I have children, those assets are going to get divided equally amongst my children. If I'm not married and I don't have children, they'll be divided amongst my parents. And of course, it gets even trickier if we're in a scenario where we're married, but perhaps we have children from another relationship, because then we have to start dividing between what's marital property, what's individual property, what goes to my spouse, what is divided amongst my children. Gets a little tricky. But what I want you to remember is not that you need to remember any of those specific rules. No one's going to walk out of here today a lawyer or be expected to read state statute. But what I want you to know is that if you do not create a farm succession or estate plan, state law is going to determine how your assets are distributed. And you may or may not like that plan. Now you're probably thinking, well, I sure like to decide who's going to get my assets if I pass away. I don't want the legislature or the law deciding that for me. So why does it happen? Why do people die intestate or without a plan? There are a lot of reasons. I really like to go back to a study from the 1980s that was done by a psychologist and has been repeated by numerous psychologists over the last several decades in different forms and fashions, and the results continue to be the same. There are a variety of reasons, including that people feel intimidated by lawyers. Boo. I know, I'm not that scary, but the reality is, if you start thinking about going into a lawyer's office, I can bet that one of the first things you're probably thinking about is, how much is this going to cost? How long will it take? How much will I pay? And am I even going to understand what it is they're telling me? And can they really help me? Those ideas or those factors can be intimidating. But it's important to recognize that lawyers are people too. They are there to help you. And so we don't want to be too intimidated. We want to set folks up for success by identifying questions that we can ask to make sure you're going in with as much information as possible. Estate planning can also be hard because it requires an assessment of worth. So putting a dollar number to your person is not often that comfortable, because of course we know that money doesn't necessarily equal value, but that can be enough to stop some folks. Some folks are also just not comfortable talking about money in their family. And of course, estate planning is challenging because it forces folks to face their own mortality. Unfortunately, we will all die one day, and that is difficult to plan for. The last two items that I'll talk about as to why estate planning and farm succession don't get done are items that I see fairly regularly in farm succession. The first one is that some folks are unable to make the hard decisions that an estate plan requires on things such as the distribution of assets. Who gets what? And how do I decide? You've probably heard fair versus equal in the context of farm succession planning. Perhaps you have one child who is on the farm and several who are not. What if that on-farm child gets, quote unquote, more than the others? Am I comfortable with that? How do I decide how much is the right amount? It's a tough decision, but we'll try to give you some tools and ways to start thinking through how you would like to make that decision today. And the last one that I'll talk about is that making an estate plan requires you to come to grips with your true feelings about family beneficiaries. So maybe it's the sister-in-law that you really don't like. Maybe it's the son who's got a gambling problem or a drinking problem. Maybe you've got multiple children who are interested in the farm and you don't know how to tell one of them that they're maybe just not owner material quite yet, or they need a little bit more work. Those are not fun conversations to have. And I will say, as well as we think about going in to meet with a lawyer, how many of us are comfortable going in and immediately dumping our dirty laundry out on the table to tell that new person, hi, I'm Kelly, and I hate this person in my family? It's not the most fun thing to do. But one of the most important things that you can do is find a way to be able to share that information with your lawyer. Because if you do have some of these unique family situations, concerns about potential beneficiaries, that your lawyer is not necessarily going to, solve someone's gambling addiction. However, if that is a concern for you, the attorney can't help you select a tool to address that problem if they don't know that it exists. And so what you want to do is try to share that information with your attorney. What are some of your concerns? And let them help you identify ways that you can still accomplish your goals while addressing some of those challenges. So there are lots of reasons why estate planning and farm succession doesn't get done. If any of these were relatable for you, you're definitely not alone. Again, these are very hard conversations, but it's really important to start thinking about, if I am in charge of deciding who gets what do I want that distribution to look like? Because again, keep in mind, the idea of intestate distribution is that if you do not create a plan for the distribution of your assets, state law will decide for you. So that's our default setting number one. I was going to drop in the chat and I'm just realizing that I didn't. So let me do it for you now. If you registered before 8:30 this morning, you received an email from me, which included the default setting analysis worksheet. Oops, let me make sure I drop that into the correct chat. I'm going to drop it in here so that if you didn't see that email, you have access to it now. But on the second page of that handout, what you will see is sort of a script. As we talk through each one of these default settings, it'll ask you some questions about how you're feeling about a particular default setting. So starting with our first one here, intestacy, the idea that if you do not create an estate plan, state law will determine how your assets are distributed. I want you to think to yourself, would I like to change the default distribution of my estate? Yes or no? And then if you're thinking, yes, I think I would like to be the one who decides who gets my assets if I pass away, what part would you like to change possibly? Is it who is receiving those assets? Is it how much each person is receiving? Or maybe it's when someone is receiving those assets. So perhaps we're thinking we'd like to have some transfers today instead of waiting until we pass away. So that's a brief start of, if you're not a fan of state law deciding who gets what, you can start thinking about how you might like to change the default distribution of your estate. Now, keep in mind, you can just check these boxes. You don't have to tell us, or you don't have to make the decision today of exactly who's going to get what. But it gives you that first sense that, hey, I don't like this default setting and I'd like to make a change. All right, so default setting number 1, if you do not have a plan, state law will decide one for you. Default setting number 2 that we're going to talk about is probate. Probate is the court process for distributing your assets. So again, if you don't have a plan, state law steps in and provides this process. And this court process includes inventorying all of your assets, valuing them, paying off creditors, and then distributing that property to heirs and beneficiaries. Now, often when we think about probate, the first thing that comes to mind for folks is the cost. And sometimes this gets confused with estate tax. So I want to be clear that estate tax and probate fees are 2 separate issues. We'll touch on probate and we'll come back to estate tax. So here in the state of Wisconsin, our probate fee is 0.2% of the value of property that is subject to administration. Well, what the heck does that mean? So if we are assuming that we haven't done any estate planning, we're going to assume that all of our assets are subject to probate. And so all of our assets are going to be subject to this 0.2% fee. So let's do a quick example. So this individual, we're going to say, is an unmarried individual. And the only things that this person owns are a $10,000 bank account with a payable on death designation, $250,000 of farm equipment, and $3 million worth of land. So their total net worth is $3.26 million. However, you'll notice that although this person thinks they haven't done any estate planning, they've done just a little bit by putting a payable on death designation or a beneficiary on that bank account. That's a non-probate transfer, which pulls that $10,000 out of the estate for probate purposes. That means that we're only going to have probate fees on the $3.25 million coming from the farm equipment and the land. Multiply that by 0.2%, it's going to be about a $6,500 fee paid to probate. I like to show this because when we think about probate and we think about the fees, those can be some scary numbers. But when you think about finding $6,500 out of $3.25 million, maybe it's not quite as scary as it seems. That being said, I do want to keep in mind too that the fees for probate may not be just the probate fee that's paid to the court, but it also might include some attorney's fees, appraisal fees. You might have realtor's fees if you're selling property. So there are other fees that potentially go along with that and can inflate that cost. So you do want to keep that in mind. Along with the cost, there are a few other characteristics of probate to consider. The first is that probate is a public record, which means that I could go down to the courthouse today and I could pull up my deceased neighbor whose estate went through probate, and I could see that list of what did my neighbor own when they passed away, what did they value those assets at that time, and who ultimately received those assets. Now, not many people are probably that nosy, but the reality is that it's an option that's out there. More often where we see the public record being a concern is if we have a child or another heir who we are disinheriting, or we are leaving less than another child or heir, and we suspect that their knowledge of that could be a problem. So sometimes we avoid probate because we want to keep some of that out of the public eye. One of the characteristics that I think is most relevant for our Wisconsin farmers is the amount of time that probate takes. So the probate process is typically going to take at least 6 months. Wisconsin does like to wrap it up in about 1.5 years, so 18 months, but it can take longer. But if we assume 6 to 18 months, what we want to know is during that time, our personal representative or our executor is in control of those assets. So the executor is the person who is going to be charged with making that inventory list, valuing the assets, paying off the creditors, and ultimately distributing that property. During that time, the personal representative is supposed to help preserve those assets for the beneficiaries. So what does this look like? I mentioned that I grew up on a farm, and so I'll use myself as an example. My brother is taking over our family farm. I clearly work off the farm. But if both of our parents got hit by a bus tomorrow and we had to go through probate, and my parents had not appointed a personal representative or an executor, we would have to petition the court to appoint someone as that personal representative. Now, if we can all agree on who is going to do that, that's great. But if we have 2, 3, 4, 5 siblings, that might get a little bit more complicated to get everyone to agree. The other thing I will say is, let's think about the time of year we're in. So it's April 16th. We've got folks that are starting to get out in the field. And again, in my situation, my brother might say to me, look, you're a lawyer. You handle it. You know how court works. You know how probate works. You run with it. I've got other things to do because I need to be in the field or in the shop right now, which might seem logical. But the bad news for him is if we have a third or fourth sibling, I'm now in charge of preserving those assets for the benefit of all beneficiaries. And perhaps our third or our fourth siblings say, I don't want him using that land. I don't want him putting more hours on the tractor that is part of this estate because it's going to decrease the value of it. I don't want you signing up for a line of credit. I don't want you pledging these assets as collateral. Now, for the on-farm child, if they don't have access to the land, the equipment, or the financing they need, that could get pretty sticky, especially if we're thinking 6 months to a year and a half that they don't have access to those assets. You might miss 1, 2, if it really drug on, I would say potentially even 3 growing seasons that could be impacted, which means that there are some risks. We want to make sure that we're thoughtful about who we're appointing as a personal representative, and again, likely making some of those decisions ahead of time. Now, one of the benefits, I will say, of going through probate is that probate does put out public notice to creditors and set what we call a statute of limitations on how long creditors can bring claims. Basically, they get 3 or 4 months, and if they haven't brought their claim and said, hey, the deceased individual owed me money, they can be barred from coming back in the future. So that is one benefit of going through probate. But there are lots of things to consider. Again, there are some fees related to probate, both the probate fee and the additional fees like attorney's fees, appraisal fees, realtor's fees. But from the creditor perspective, it might set a statute of limitations, or it will set a statute of limitations on our creditors. But it is a public record, and it does take some time during which that personal representative is in charge of those assets. So if we're thinking about probate as a whole, again, it's a court process for inventorying those assets, paying off our creditors, and distributing property to heirs and beneficiaries. Again, if you're looking at your handout or you're jotting down notes from the slide, you want to think about which characteristics are the ones that I'm concerned about. How do I feel about probate? It might be a good option for some folks, and for others, they might think, this isn't the best thing for my family. But which parts are you concerned about? Is it the fees? Is it how long probate might take? Is it who my personal representative or my executor will be? Is it privacy from the public, heirs, disinherited individuals, or other family members? Or I added a line on there too. Is it something else that you've heard about probate that is concerning you? So far, we've talked about intestacy, the idea that if you do not create a plan, state law will decide how your assets are distributed. We've talked about probate, this court process. It has some pros and cons, depending on your family situation. And the third default setting that we're going to talk about is estate tax. So here in Wisconsin, we do not have a state level estate tax, but we are still subject to the federal estate tax. The federal estate tax ranges from 18 to 40%, but we have to remember that each person has a unified estate and gift tax credit. So if you just got done doing your income taxes, think of this kind of like your standard deduction or your itemized deduction. We get this credit that applies before any estate tax is due. So in 2025, the estate and gift tax credit is $13.99 million per person, which means that I can pass $13.99 million to anyone I'd like without any estate tax being due. It gets even better if you're married because each of both you and your spouse have this $13.99 million credit. And several years ago, they made the concept of portability permanent. And what portability means is that if we're spouses, we can share our credits. So together, we have $27.98 million worth of assets that we can pass before any estate tax is ever going to be due. Now, we do want to keep in mind, as we're, a third of the way through 2025, right now, the estate and gift tax credit is set to expire at the end of this year and return to about $6.98 million adjusted for inflation. We'll certainly have to see what inflation does this year to see where that number goes. But it's expected to return to about that $6.98 million number. We'll still have portability, which means that if you're married, you have $6.98 million that you can pass, and your spouse has $6.98 million that you can pass, for a total of $13.96 million. So that's a lot more than most folks think. And again, keep in mind, you can pass that dollar amount before any estate tax is ever due. And once you cross that dollar amount, the tax doesn't apply all the way back to zero. That dollar amount is exempt, and we're only applying it to the amount that's above that credit limit. In addition to that, we also have an annual gift exemption. So in 2025, that annual gift exemption is $19,000, which means that I can give $19,000 to whomever I would like this year without any consequences to that individual or to my estate and gift tax credit. So I can give Joy $19,000, I can give Anna $19,000, I can give David $19,000, I can give Kevin $19,000, and there's no estate tax consequences for me or for those individuals. Now, as soon as I cross that annual gift exemption, I give Kevin $19,001. That $1 extra is going to start counting against my unified estate and gift tax credit. So if I passed away at the end of this year, I'd have $13.99 million minus 1 for the 1 over 19,000 that I gave to Kevin left to use. So that's why it's a unified estate and gift tax credit. It gives you some ability to transfer assets before your death and take advantage of that credit, or to be able to pass assets at the time of your death. Okay. I had one more thought on the estate and gift tax credit, and it has floated out of my brain for the moment. It will hit me again later, and we'll talk about it. Tax basis. There we go. So one thing you also do want to keep in mind is, of course, the difference between a transfer at death and a transfer via gift, as we're thinking about tax basis. So you may have heard of or be familiar with the step up in tax basis. If assets are passed at death in certain ways, and let me back up. If assets are owned at the time of your death by you as an individual and they pass through your estate, you're likely going to qualify for that step up in basis. However, if we're giving a lifetime gift, then the recipient of that gift is not getting a step up in basis. They are taking your current basis. So for example, there was an individual that I worked with last year who mentioned that his father had purchased land many, many years ago at about $3 an acre. So dad had basis at $3 an acre. However, the land today is worth about $10,000 an acre. What that means is that if they sold that land today, they would have to pay capital gains tax on the difference between $10,000 and $3,000. However, if dad passed away holding that land, the land would get a step up in basis, up to fair market value at the time of death or 6 months later. So we would assume we're going to get that step up to that same $10,000 an acre number. If the next owner then sells that land, because their new basis is $10,000 and the sale price is $10,000, there wouldn't be any tax due. So there are different consequences to the planning that we do, but what you want to keep in mind is that you do have a fairly large exemption that you're able to use when we're thinking about estate tax. And so I encourage folks to think about, is estate tax a problem for me, before I choose a tool that perhaps is fixing estate tax if it's not a problem to begin with. Basis is definitely secondary to that, so we might not have an estate tax problem, but we might be structuring our transaction in a way that considers tax basis. Something to keep in mind. We'll talk a bit more about that in a moment. So let's do another quick example. Our individual from before, who, as I mentioned, was unmarried, still has $10,000 in a bank account with a payable on death designation. They still have $250,000 of farm equipment, and they have about $3 million of land. Their estate value is $3.26 million. And the reason I do it this way is because I want to point out the payable on death designation removed our bank account from probate, but it doesn't remove it for estate tax purposes. So it's still included here. A perfect example of the idea that choosing a tool that addresses one thing may not address another. So in this scenario, we have $3.26 million in the estate, but that is well below the exemption of $13.99 million this year, so no tax, and well below our $6.98 million expected for next year. So we probably don't have an estate tax problem here. Although we hear a lot about estate tax, U.S. Department of Agriculture's Economic Research Service did a projected study last year comparing at the time they expected it was going to be about a $13.95 million exemption. Clearly, we got a little bit higher compared to what's going to happen when we see that decreased $6.98 million exemption. And you can look if you'd like to identify which farm category you might fit into, feel free to do so. But I want to point out that under our $13.95 million exemption, USDA estimated that it's only about 0.3% of all farm households that are going to have estate tax due. Once that number drops to that 6.98 million, they still estimate it'll only be about 1% of estates that owe estate tax. Now, keep in mind, these projections are done assuming that no one is doing any estate tax planning. And so if you are a farm that, or a individual or a couple that falls into that category of having a high net worth above the potential exemptions, you may want to do some planning to be able to avoid paying estate tax. So just a quick example of where this can be challenging over the next year or so as we see this transition with the exemption. We have bumped up our estate in this example. Now this individual has $100,000 in a bank account, $1.25 million of farm equipment, and $6 million of land, for a total estate value of $7.35 million. Which is, again, well below that exemption of $13.99 million. So we don't have any tax issues, any estate tax issues if they passed away in 2025 or prior. But it is above the exemption of $6.98 million that's projected for next year, which means it is possible that they would have some estate tax if they passed away next year or in the future, meaning they may want to think about this as they're doing their planning. So how does this apply to you? Again, looking at our handout, or if you want to use what's on the screen, it says the same thing. What I want you to think about is my net worth is. And if you're trying to think about your net worth, you might think about if you have a farm balance sheet or an individual balance sheet, all of your assets minus your liabilities, and then what is that leftover equity number? My net worth is. And if you have an estimate of that number, then you're going to ask yourself, is that more than, less than, or close to that $13.99 million exemption? And if you're married, think about if it's more than, less than, or close to $27.98 million. So that's for 2025. Then we're going to look at 2026. Is that net worth number more than, less than, or close to $6.98 million or $13.96 million if you are married? And then based on that, I do or do not think I need to worry about federal estate tax. I would say if you're more than or close to, you probably want to think about it. It doesn't mean that there aren't tools to plan around it, but certainly you would want to look into what those tools are and how they might work for your farm situation. If you're wondering about why is close to included, one of the reasons that we include close to is because we don't know when we're going to pass away. And so if we are hopefully going to live for a few more years, we might see appreciation in our assets. So thinking about how land prices have risen, thinking about some of the changes in the value of equipment that we're seeing recently, even the values of inventory, the values of cattle. Maybe you're just planning on winning the lottery next year. Any of that appreciation, expected income, expected inheritance, if we're already close to that number, those increases can put us over and show us that we may have an estate tax issue that we need to think about. Now, keep in mind, of course, for this slide and for the others, these are not the end-all be-all. It's a starting place. So it's not a perfect calculation, but it's a quick check to say, hey, I'm nowhere near 13.99 or 6.98. I don't have to be as concerned about this as maybe I am. Or perhaps it's a check that says, oh, I am awfully close or over those numbers. I need to make sure I'm doing some planning because this is a real issue for me. Your attorney and your accountant are going to help be checks on this, right? So you can go in and say, hey, I've looked at this and my net worth is about this number, and therefore I think I have a problem with estate tax. Can you confirm? How do we address this? It just gives you a starting place for that conversation. So we've talked about intestacy, the idea that if you do not create a plan, state law will decide the distribution of your assets for you. We've talked about probate, that court process for inventorying assets, paying off creditors, and distributing the assets, which again, pros and cons. It takes some time, but it does put a statute of limitations on creditors. It is public, and it does have some fees associated with it. And we've talked about our third default setting, estate tax, with a quick, easy way to compare your net worth to the current exemptions to see if that might be a concern for you. The last default setting that we're going to talk about is long-term care and retirement planning. And of course, the default here is that if we don't have a plan for how we're going to fund our retirement or our long-term care, we're going to need to use our income or our assets to do that, right? And so we want to get a sense of what does it cost to receive those services or to live the lifestyle that we are looking for. Again, if this is something that is potentially an issue for you, you might be thinking about long-term care insurance. You might be thinking about tools that are going to provide future income. You might be thinking about if you'll try to take advantage of Medicaid, which is that government assistance in paying for nursing home care. I do want to just remind folks that if you are thinking about Medicaid, Medicaid only kicks in when you are impoverished, which means that you've only got a few $1,000s worth of assets left, other than exempt assets. And exempt assets, while they are exempt, at the beginning for the application, they are still potentially subject to recovery after your death. So we do always want to keep that in mind. So if you are trying to qualify for Medicaid, most of those assets cannot be in your name anymore, or they have had to already be used. On top of that, Medicaid may not provide the standard of care that you're looking for. So it might not be a private room, it might not be in-home care. And so what we want to do upfront is just think about what are our goals for our later years? What do we want those years to look like? And what might we have financing to provide for that? Because again, if we don't have a plan, again, the default is that you're going to have to use your income or your assets to pay for those years. So as we wrap up on default number 4, I just want you to think to yourself, what is my long-term care plan? Is it to use assets by selling them? Is it to leverage assets? Is it to apply for Medicaid? Do you have long-term care insurance? Do you have retirement accounts? And then based on that, I think I will or will not need additional income from my assets beyond what I have today. Now, if you're thinking, Kelly, I have no idea what that's going to cost, you're not alone there either. Again, on the handout that was emailed to you earlier today and that I dropped in the chat earlier, if you look at the blue box titled Long-Term Care and Retirement Planning, in that box, I have a link to Ohio State University's Law Library for Estate and Transition Planning. They do have a long-term care risk calculator on that site that you can download. It will provide links that will help you figure out an average cost of long-term care services in your area and what some average number of years of needed care might be. You'll, of course, want to think about your own family history and how that might factor in. But it will help you figure out a rough estimate of what is the cost of future long-term care going to look like, as well as it has a section where it allows you to put in, just in large categories, what your current asset situation is. So what do you have in liquid cash? What do you have in inventory that's easily liquidated? What do you have in farm equipment? And then what do you have in land? Then it compares those asset numbers to the income or to the expense that is expected for your long-term care needs. And it assumes that we're going to liquidate cash first, inventory next. I think it's animals third. I might have those two mixed up. Equipment fourth, and last, it assumes that you'll want to sell land, meaning you're going to want to hang on to that. And what it will do is it'll show, based on the projection, just how far into your current assets will this potentially cost you. All right, so that's a lot to take in. But let's think about, how do we use the information about those default settings? So if you print off the default setting handout and you fill out that script on the back, you might just share a copy of that document with your lawyer as you start talking about your farm and your family and your goals for succession. And it gives you sort of a guide to say, I think I want to change intestate distribution plans. I think I might have an estate tax problem. Can you check that and look at it for me? They should be doing this anyway, but it helps provide a guide to the conversation as you're getting started. And it also provides a way for you to check those items when a plan is presented back to you. So if someone says, I think you should do this type of trust over this many years, these beneficiaries in this way, you might say to them, okay, how does this affect distribution? Who ultimately gets what? Do I still have to go through probate? How will this impact my estate tax consequences? And what will this mean for my long-term care plans? We've just covered 4 major topics, both on the front end of the conversation with that advisor, as well as on the back end as you're trying to sort of check their work and make sure that that plan is doing what you'd really like it to do. If you're not comfortable sharing a copy of that document with them, you might also use it as a script to talk with that lawyer about your concerns or what you're seeing as potential issues. One item that is on the handout that I didn't put in the slides is family dynamics and habits. So I am worried about, and this is where I want you to think about those really tough topics we talked about earlier. Are we worried about someone's death, divorce, spending problems, drinking, gambling, minor children or grandchildren, children or grandchildren with special needs, in-law relations, business concerns, bankruptcy concerns, all of those sort of, well, all that dirty laundry, essentially. It's really tough to acknowledge. But again, we can't expect our lawyer to solve that problem if we haven't told them that we think there's a problem there. Another one that I really should add to the handout, and I'll mention it to you all because I want you to know, this might also include something that's not dirty laundry. It might just be, hey, I have a partner who I'm not married to, and I have children from a previous marriage. How do I provide for my partner if I pass away first, while still making sure that my assets end up with my children? There are ways to do that. And so one of the biggest things that I hope to impress on you is what you want to do is share with your attorney what your goals are and what your concerns are, because there are lots and lots of tools out there. But if we don't know what problem we're trying to fix, it's really hard to pick the right tool. So you can use that script to help you as you're having that conversation. And I know that your head is probably spinning. You don't like the defaults that we've talked about. So now what do you do? Because maybe you're looking at that script and thinking, I don't know that I'm ready to have that first conversation with a lawyer, but where do I go from here? And I always like to point out, there's more that can hold us up. Legal risk 2.0, we're still afraid of getting it wrong. Whether that's estate taxes, step-up in basis, probate, income tax, SE tax, capital gains, depreciation recapture, successor and heir disputes, long-term care, retirement planning. What happens if I get hit by a bus tomorrow, Kelly? There's so much to think about. One of the most important things is that you just keep moving forward. I really like to focus on the 4 default settings because they're what drive our plan. They're the original problems, or for the younger folks on the call, the OG problems. They're the problem we're trying to fix and we're trying to select a tool for. These other items, whether it's a step up in basis, whether it's an income tax or SE tax issue, those are some of the consequences as we implement the plan. So let's first identify the problem. Then let's try to figure out what tools are going to fix it. And then let's evaluate how we feel about the consequences. If we start at the consequences before we've even identified the problem, this road to a farm succession plan gets pretty murky. So again, in case anyone wants to jot a note on it, I really encourage you, default settings, identify which of those defaults you feel like are a problem. Then we're going to try to ask our attorney to help us identify some tools to solve those problems and to get us to a perfect world. And then we're going to start evaluating those consequences and deciding if there are additional changes to make. Again, if your head is still spinning, you're not alone. This is so often why estate planning doesn't get done. All of the issues that we talked about earlier. Going in and talking with a lawyer can be intimidating. It's really hard to talk about our finances, and it's hard to talk about our families sometimes when there are issues that we're not quite sure how to address. And it is really hard to make those decisions about who gets what. And so you may not be ready to draft up the plan tomorrow, but now you're a few steps ahead. You've started evaluating those defaults. And the next thing that I would encourage you to do, if you're perhaps looking at me like this, is think about what baby steps we can continue to take to move the process forward. So the first one that I start with is that you can't give away what you don't have. So I always say, I would love to give my wedding ring to my daughter, but I don't have a wedding ring and I don't have a daughter, so that's going to be pretty hard to do. Now, I'm going to have to get a new joke pretty soon, but for now, that's the one we're going with. But the idea behind this is we have to know what you have. And so one of the best things that you can do to help your attorney is have good financial records, a good balance sheet, a good cash flow statement or income statement, if you've got time for those, understanding what are the assets that we're trying to move and what are the budgetary needs of the farm, the current owner generation and the future owner generation. Those items help us figure out where do we have some wiggle room as we're moving assets around. We want to figure out what is it that we have before we start trying to give it away. That's also in part because, again, we need to know what we're trying to fix before we start selecting tools. So we talked about our 4 defaults and started trying to identify where are the problems with intestate distribution, probate, estate tax, and long-term care. We need to identify the problem before we pick a tool. If I decide that I want to hang a painting on my wall, I don't just go out to the shop and grab a chainsaw. I don't just grab any old tool. It's an effective tool, no doubt, but it's maybe not the tool for the problem that I'm trying to fix, which is that my painting isn't on my wall, right? And so the same thing is true here. We want to figure out what it is we're trying to do with our 4 defaults. And again, our perfect state based on what we financially can support with the operation and the transfer before we start selecting those tools. And the last thing I'll leave you with is make sure you have a professional explain the tools. I mentioned I grew up on a farm, but I can assure you I am not the girl that you want in your machine shop. I actually won a set of tools a couple of years ago, and one of them was an impact wrench. And when I bought my house and my brother brought my tool chest and my box of all my tools over, we had a big discussion about the impact wrench because he said, you're never going to use it and you really don't know how, so you probably shouldn't try. And I said, but it's mine. I want it. I want to have it. And so he brought it along, he dropped it off, and he looked at me and said, Kelly, promise me you're not going to use tools you're not authorized for. Because he's exactly right. I have no business using that impact wrench. That being said, the same thing is true when we think about legal documents. It might seem easy to go print something off the internet or use ChatGPT to draw something up for us. But if we don't have a professional helping us use those tools, they can create more problems than solutions. So we want to figure out what is it that we have, what are we trying to fix, and then let that professional help you identify which tools are right and how we should use them. So again, prep and review your financials, pull together any current documents that you have on your financials, your entities, deeds, titles, and make sure you're talking about those long-term needs and distribution goals. Because again, we want to know what it is we're trying to fix and what we've got to work with before we start selecting those tools. So it's 1:32. I'm happy to take some questions. We do have 15 minutes for a break built in, as you probably remember. So just a reminder again, on the bottom of your screen, you can type into the Q&A box. It's going to have a little question mark and a chat bubble. And those questions will come through to Joy and I. I will stay here during that break so that if anyone wants to ask questions, we can do so. But otherwise, we will come back at 1:45 and Joy will take over.